What's up, guys? Back with another video. I'm filming back to back this time, but I'm going to make this actually short this time, and I'm being for real, being honest. So let's talk about mortgages, the mortgage market. So some of you guys may or may not be renting right now. Some of you guys may or may not have a home right now. Let's talk about mortgages. So obviously we know mortgages is a long-term loan secured by real estate to pay principal and interest each month. Unless you want to buy it in cash, that's on you. But let's talk about that. So you have amortization of a mortgage loan. And the first thing I want to tell you guys, if you don't already know, a lot of you might have heard this, but once you get into a loan for a mortgage, you are paying, and this is any loan actually that you get into, a long-term loan, whether it's a car loan, mortgage loan. You're paying interest first. So when you pay that first payment, it's going to be applied towards interest. Then when you get towards the middle of the loan, that's when you start evening out on interest and principal, the base amount of the loan. And then once you get towards the end, you're paying off the principal. So whenever you get into a loan, you're paying off the interest first. That's why you have your APR. That's why you have your annual percentage rate. You are paying off interest in the early stages of that loan. Now, only way you could really get rid of that is if you just pay a whole bunch more. So you pay off your loan early, extremely early. But just to let you guys know, you're paying off your interest first, not your principal, interest. And that is kind of the best thing because you don't want to have interest tacked on the end. The interest keeps accumulating over and over. So you pay it off first with the interest, then you pay the principal off at the end, and that's how your loan ends. Let's talk about balloon loan. A balloon loan is an amortized loan that may be due. Okay, this is an example. It may be due in 5 years, but the payment is calculated as a 30-year mortgage with full principal due at the end of 5 years. So it's a balloon loan. It's an extremely big loan. So let's say that it's due in 5. So you're like, man, 5 years for a mortgage? You never know. People have the money to pay that off. But it's calculated as a 30-year mortgage. So they're telling you, hey, you can pay this, and that, these small amounts, but that full principal is going to be due at the end of the 5 years. So if you have the money to do that, then maybe you want to do it good for your credit score. That's how you can do it. But please don't enter a balloon loan and you say everything's fine and dandy and you got to pay the whole principal amount of that loan at the end of the term. That is how you get caught. And that is not a good way to go out with your credit score. That's not a good financial thing to do. That's not advice. That's just a fact. So let's talk about the stated rates on mortgage loans. So stated rates on mortgage loan is determined by 3 rates. So whenever you get a rate on a mortgage loan, there's 3 factors that go into it. You have your market rates, which are general rates on treasury bonds. You have your term rates, which is the long-term mortgages have higher rates because you go on the long term, you never know. Everything's subject to interest rate fluctuation. And your discount points, which is lower rates negotiated for more cash up front. So if you put more cash up, a bigger of a down payment on a mortgage loan up front, you have discount points. Discount points. Keyword, discount points. Like, man, this mortgage is a lot. Put down a couple more thousand on that bad boy, a couple more 10,000 on that bad boy. Why? Because it can help you lower the payment. It's just a fact. If you put down more money, you get a lower payment. Now, obviously, everything comes in terms of how long you have the loan, but everything that you take a loan out on, higher the down payment, less of a payment. That's called discount points, the mortgage market. So when you have things for loans, you have terms. Your collateral, your real estate. With being in finance and the down payment, that's your loan terms right there, your collateral. So if you don't pay off that house and you're like, man, I just can't pay it off, well, that house will be taken right back. Foreclosed, taken right back. Because the bank is going to say, you can't pay us off, so we're going to take the house from you. That is their collateral. That is what's being backed for the loan. That down payment, your loan terms. You put that money down, that should tell you, if I put that money down, I don't want it to go to waste. So make the right decision, put a good amount down, and understand that you will be able to pay off whatever your mortgage, whatever loan it is, you can pay it off. But that mortgage loan, you can pay off the mortgage each month that is due. And PMI, private mortgage insurance. So for any of you guys that want to buy a house in the future, buy a house, be a homeowner. Insurance company is going to check if you default on your loan and if the bank can take a loss because they're going to check everything. They're going to check your credit history, check your default history. So PMI depends on your credit score, your loan price, etc. Private mortgage insurance. So if you put, and I believe the number is less than 20% down payment on your house, you're gonna have to get that PMI regardless. You have to get it. But if you put more than 20% down, that mortgage, private mortgage insurance, you're good. You don't have to. I believe it's 20%. If you guys have the right number, please correct me. But I believe from school it told us it's 20% or less. You have to get PMI. So let's talk about credit scores. For a mortgage loan from 2021, what we learned is that 660 to 720 is the average credit score. So I encourage you guys early. Go back and look at my first couple videos about credit cards. Build your credit score up, guys. Build it up. If you have to take out a loan for one thing, take out one loan. Make sure that it's enough you can pay back within the loan period, if not earlier, so that way you can just build that credit up. So that way you can look trustworthy to banks. That way they can say, hey, we'll give you this loan for this house. Hey, we'll approve you for this. But you have to show you're trustworthy. There's trust into these things because nobody is going to have adverse selection and say, oh man, why would I pick somebody that has a history of defaulting? Now I make the bank look bad. Now I look bad. It's business. It's key, it's simple, but it's business. You have to show that you're trustworthy because nobody wants to put a contract up for you and you're the one that's going to end up breaking the contract so easily. You have to show you're trustworthy. So fixed mortgage rate, you have a level payment. So when you have a fixed mortgage rate, then you just pay a certain amount each month till the mortgage is up. That's your fixed mortgage payment. But the key thing to get out of this today is that when you guys go into the mortgage market, whether that's to buy a house or you want to be a landlord, sir, but mostly to buy a house, you have to understand two simple things that I want you to take away. Number one, like I said, I believe it's 20% or less PMI, private mortgage insurance. If you don't put down that 20%, you're going to have to take it out. Trust me, it'll help you in the long run. Number two, understand you are paying your interest off in the first stages of the loan. Once you get towards the middle of the loan, halfway through to that checkpoint, principal and interest are usually balanced. Then we get towards the end, you're paying off principal. So understand that your loan is amortized from interest to principal and interest to principal. That's how it goes in three stages. Start at interest, middle, interest and principal, at the end, principal. And that's about it right there. I see my other notes. There's nothing really spectacular to really talk about, but that's the mortgage market simply. So guys, remember, please be trustworthy with your credit. Show that your credit history means that you are a good person with your credit. And if you need any credit tips, please watch my first two videos. They will be very helpful. Thank you guys for watching. Please tune in next time. Appreciate you guys.